the equation for common shareholders' equity is the difference between the assets and liabilities. Do you know that there is a difference between the operating activities, investing activities, and the financing activities? You know, there is a difference among these three activities. Yeah. Okay. As an analyst for stock, which part is most crucial for you? I mean, which part generates value for you for the stock? Operating part, investing part, or the financing part? Operating activities. Okay. Operating activities is your main task. Operating activities is your main task, and the investing and the financing are your supportive task or your backward task. Okay. Ultimately, you like to engage in operating, and there's a difference among these activities. And we know that we are familiar with these equations that asset can be expressed as liabilities plus common shareholders' equities. So how common shareholders' equity can be calculated? We know that if we have the common shareholders' equity existing, we need to add the profit from the from this current year, and we need to subtract the dividend payout to get the current common shareholders equity. These are some definitions. And we know that the balance sheet is reflects this equation, and income statement reflects the difference between the revenues we are generating and the expenses we are incurring. Okay. And the income statement reflects the profit by making the difference between the revenues we are generating and the expenses we are incurring. And we will see that these are interconnected. These are interconnected. These are some primary understanding. I do not like to spend time here how these are interconnected, but I like to understand that balance sheet is useful for number of purposes. We mentioned it in the very beginning of the previous class, but in summary, it reflects the financial health. It reflects the financial health, and this balance sheet includes asset and liabilities, but their assets have differences in terms of their purposes. Say, for example, accounts receivable and marketable securities. If you understand the operating activities and the investment activities very clearly, can you please mention that which one is related to operating and which one is related to investment activity? I mean the between account receivable and the marketable securities. Tanzina, we get cash flows from operating activities, obviously, and we also get cash flows from investment activities, but investment activities is not our operating part, it is our non-operating part. Yeah, MS is related to investment activities. Okay. Now you see that a company which is a kind of say manufacturing company. Okay, a company is a manufacturing company. So if that company generates more cash flows from their investment in marketable securities and less cash flows from selling their goods on credit or selling their goods to the customers. Is it good that the company is it good for you? The company is generating more cash flows from, the company is generating more cash flows from the marketable securities. The company is not generating more cash flows from sales. Is it good for the manufacturing company? No, it is not good. So during the COVID pandemic, many textile manufacturing companies, of which their primary business is to sell textile and to earn cash flows, they found that the textile demand falls and they invested a significant amount in the stock market and they generated a good amount from the marketable securities investment. So we know that these two activities are different, operating and investment activities, and these two activities should be separated out. These two activities should be separated out. And again, you see that a company incurs expenses. A company incurs expenses, or a company incurs cash outflow. The company incur cash outflow for the cost of goods sold. A company also incurs cash flow for interest expense. Are these cash outflows categorically same? Or you understand that cost of goods sold is a kind of cash flow which is related to operating activities, and interest expense is a cash outflow which is related to investment or financing. Financing, yeah, good. So as a financial analyst, you need to separate the activities. Separate the item based on the operating and investment part, because you know that operating part is value enhancing activity. Operating part is value enhancing activity. Are you familiar with the Modigliani and Miller model, the most famous model in finance? You're familiar, okay. So you do business, you generate value from business by investing your money in some profitable opportunities. So what says that you generate the amount, or you finance the amount by debt or by equity. It does not make any difference. It does not make any difference. So you generate money from equity or you generate money from debt. Does it make any difference according to for the purpose of generating value? Can you change your value by switching from equity to debt or switching from debt to equity? Can you enhance the value or can you increase the size of the pie? You cannot. Okay. So you see that which part is important to the the financial analyst for if their concern is the value. Their concern is to look at the operating part. Okay. So if their concern is to look at the operating part, they need to identify their assets, liabilities which are related to operating, and they need to separate the assets and liabilities which are related to investing and financing. Okay. Now you see that how operating and investing and financing are related. We are aware of this, that how it happens. And you see that by generating value from the operating activities, what company or managers do, company returns value to the fund providers. It can be shareholders, it can be creditors. Okay. So we show the financing activities and investment activities in the balance sheet, and for operating activities, we rely on the income statement. So from this understanding, we know that irrelevance theory or capital structure theory is not something worthless. Okay, and there are some reasons for which it is believable, apart from the strict assumptions which are behind the proposition. Okay. Now the thing is that we like to talk about the reformulation. So what is reformulation? So reformulation is nothing, just to convert the traditional balance sheet to a reformulated balance sheet by separating the balance sheet items, or by separating the income statement item, or by separating the cash flow statement item into two classifications. One classification is operating, and another classification is financing, or in case of asset, you will see that it is part of investing. Okay, so it's the operating activities that add value to the business, and we have to be very much clear about this part, operating activities, because these activities create value. Okay, you see that how the companies showcase their performance. The companies showcase their performance by measuring EBIT and average asset. But you see, this EBIT includes income from operating activities. This EBIT also includes income from investment activities. So again, for average asset, you see the assets include some asset like account receivable, which is kind of operating asset, and marketable securities, which is a kind of investment asset. Okay. Yeah, it is ROA. But you see, from this classification, or from these financial ratios, which is available from the traditional balance sheet, you do not have the idea at how much what is the performance of my operating asset is. Because from the conventional balance sheet, I do not know that how much of my asset is operating and how much of my asset is investing. So if I see that I'm getting more performance from my operating asset, it is good for me as a manufacturing company. But if I generate more return, in terms of ROA from the investing activities, it is not a good thing for me, because it will not be sustainable given that I'm a manufacturing company. Okay, so we need to separate the out. So have you got the idea of the reformulation, what we are going to do? I have not shown it, but have you got the idea that what is the idea of reformulation? Can you write your response in the chat box, what we are going to do? Your forwards, what we are going to do for the purpose of reformulation. We are going to You got it, obviously, but what we are going to do? We are going to separate the financial statement items from the conventional format to reformulated format by separating some items into operating part and the investment part. Okay. Separate items on the basis of activities. Good. Okay. So we can rewrite the accounting equation, what we recapped earlier, in this way. Assets can be classified again in operating assets and financial assets. And liabilities can be classified into some operating liabilities and the financial liabilities. Can you help me to give by giving an example of operating liabilities in the chat box? Operating liabilities. From our today's discussion. Yeah, accounts payable, good. But from our previous discussion, can you please, warranties is related, but how you will tell in accounting term? Deferred tax. Okay. Accounts payable, I have not got my answer yet. Can you recall the deferred revenue I mentioned in the software case? Deferred revenue or unearned revenue. Okay. That is a part of operating liabilities. Okay. Now you see that if I notify as operating assets as OA and financial asset as FA and operating liabilities as OL and financial liabilities has been mentioned as financial obligations. The debt is financial obligation. Now plus CSE is not computer science engineering, it's common shareholders equity. Okay, if you are not in class, you might understand that it's kind of different thing. Okay, it's common shareholders equity. Okay, now you see that if I take the operating liabilities in this side, and with the financial assets in this side, and financial obligations minus financial assets plus common shareholders equity. So the difference between the operating assets and the operating liabilities will be known as net operating asset. Net operating asset. Okay. And the difference between the financial obligations and the financial asset will be known as net financial obligation. Okay. Now you see, if a company needs to be sustainable in its equity, it needs to generate profit in this part, produce sustainable operating profit. Okay. But this thing is helpful for an analyst to measure what is going on in the capital structure part. Okay. Now, if we understand the equation, what can we do? We can classify all of our assets into two categories. One is operating asset, another one is financial asset. And we can also classify our liabilities as operating liabilities and financial obligations. Okay. And these two parts will be considered as net, I mean the total asset. And these three parts in total will be considered as liabilities and equity. So these are same thing, same as accounting equation. There is no difference. Now this is a kind of the same thing. What can we do? We can take the operating liabilities here, and we can think of operating asset, and we can also separate the financial assets and financial obligations separately. Okay, this is the. So you see, this is the things which are in the box is the thing of interest. Okay. So the difference between operating assets and operating liabilities, net operating assets, we need to look at it very carefully. And this is the primary thing we like to see from our restructured financial statement. And the financial obligations and owner's equity, what we have done, we have separated these things out in the bottom part. But which part is value generating? This part is value generating. Okay. Now this is a typical balance sheet. Why it is a typical balance sheet? Because it has been prepared either based on GAAP or prepared based on the IFRS, which shows that classification of assets in current asset and classification of non-current asset. And again, the liabilities, current liabilities, non-current liabilities in equity. Okay. And you see, this is a typical form of balance sheet in the financial statements. Okay. So in this course, as a financial analyst, you cannot rely on the typical balance sheet because you do not have the story of the operating activities separately from this typical balance sheet. What you need to do, you need to recast the items into the categories we just have learned. So we need to reformulate. So what can we do? We can separate the items into operating and financial. How? Out of the assets, what we mentioned, you see these assets are kind of financial assets. Cash and cash equivalent, marketable securities, notes receivable, derivative, financial instrument, other investment. These are some financial assets. And other than this, other assets are operating assets. So think of PPE, property, plant, and equipment, or intangibles, or you can think of leased asset. These are kind of operating assets. And in liabilities and shareholders' equity part, what can we do? We can separate the financial part, the bank overdraft, borrowings, non-current and current maturities of long-term debt. You see, what we do this, or we take this for the purpose of financing, right? And other than these financial liabilities, we have some liabilities which will be considered as operating liabilities. So we need to think of these items and we need to apply this. And the equities are as like before, common equity plus retained earnings. And if we have any non-controlling interest, it needs to be adjusted. Okay. So we need to distinguish between the operating and the financial activities. So the same thing in the tabular format, not in the tabular format. Yeah, it is in the tabular format. Same thing. A typical the balance sheet from the GAAP, and we have our companies which prepare the balance sheet using the IFRS, and it's also looks mostly similar, but there are some differences. Okay. So you see, it is a reformulated balance sheet. What do we see? The same thing, but in different categories. Financial assets, operating asset, and in the liabilities part, we have financial liabilities, operating liabilities. And this is, we'll talk about it later, the income statement. Okay. Here you see, this is a GAAP based balance sheet and the common category. And what can we do for the financial statement analysis purpose and for the purpose of valuation? We can recast the items into reformulated balance sheet. How? When you see the O letters are coming, what does it indicate? What is your idea? If the O letter O is coming, what is your idea? Is it indicating something operating or financing or investing? Yeah, good, operating. And you see that short-term borrowings, current portion of long-term debt, these are financing. Okay, long-term debt financing. And deferred contribution to employment stock option, then the other liabilities, accounts payable, these are operating. And now you see that if we separate the operating asset and operating liabilities, we will have this kind of reformulated balance sheet. Okay. We need to understand that how we will categorize it as operating and how we'll categorize as investing and financing. Okay. Let me talk about one item in today's class, and we'll talk about other items in next class. Okay. Yeah. Let me take the yellow. You see the cash. Do we need cash only for investment activities, or we also need cash for operating activities? What do you think? We need cash for both operating and investing. But what do you think? The cash required for operating is to be a big number. I mean, we have cash balances, but do you think that cash has some ambiguity? Cash has some ambiguity in a sense that we need to look into detail. Sometimes you will see that it has been mentioned cash and cash equivalent. So cash equivalent indicates something which has been maintained in some short-term account, like a current account in this way. Okay. So usually cash balance, when it is only cash, it is treated as an operating asset. Okay. But when you see that cash is has been mentioned and also cash equivalent has been mentioned, I mean these two items have been mentioned together. In that case, how much you need to how much of the cash you need to consider as investing, or how much you need to consider as operating. Okay. The thing is that it has there's a rule of thumb that you need to find out what is the 0.5% of sales. 0.5% of sales. Usually the operating cash has a relation with the sales and your working capital. And usually it is the analyst use 0.5% of sales as operating cash. So say you have, if I have the sales amount here, I do not know whether it is here. Yeah. Say, for example, this is our sales amount. So take 0.5% of sales. And if you see, say, for example, the amount is 10,000. Say that amount is 10,000 from here. Analysts are saying that 10,000 is to be considered as operating cash. And you see this amount is bigger than 10,000. This amount is bigger than 10,000. So the total amount is not considered as operating asset. Rather, 10,000 is considered as operating asset. So we'll discuss more about the reformulation of balance sheet in the next class. It is too much today to absorb. Okay. we have learned that the reformulation of the financial statements is essential to distinguish between the operating items and the financial items. And we have learned that we are keenly interested to learn about the activities which are value generating. And based on theories and based on some empirical analysis, we have convinced that operating activities are the primary drivers of value generation of the firm. Okay. So these are the things we like to know from this content, and why the reformulation is desirable and how the knowledge of business is incorporated in the reformulated statement, and how operating and financing components of the financial statements are identified. And we'll try to explore that how we'll allocate the assets and liabilities into operating and financing categories. And we will spend time for knowing that how income taxes can be allocated to different parts of the income statement, and what balance sheet and income statement ratios reveal. Okay, so these are the some purposes for which the reformulated financial statement will help us. It will distinguish between operating and financing activities. It will also help us to make common size and trend analysis. You probably can recall that we talked about the common size financial statements when we talked about vertical and horizontal financial statements. And when it is trend analysis, you can think of the horizontal common size financial statement. Okay. Then we already talked about the balance sheet and income statement issues, and when the financial statements have been reformulated, in that case, you will see that there has been changes in these ratios. Okay. So this is a typical standard balance sheet, and we need to have a very clear idea. And I strongly believe that you have learned a lot about the standard financial statements from your financial reporting course in the second year, and I believe you spend a lot time in that course to know that how to work with the financial statements and how to prepare the financial statements. Okay. So you see the typically what is done in the financial statements, the balance sheet. We'll be spending time again with the balance sheet now. We'll be talking about the income statement later of the after this class. I mean, in the next week we'll talk about the income statement. Okay. So you see the balance sheet assets are categorized into two groups in general balance sheet or standard balance sheet. One category is current asset and another category is long-term asset. And in case of liabilities, we see that the liabilities are categorized into current liabilities and the long-term liabilities. You see the assets starts with current asset, but the liabilities start with current liabilities. So what is the justification behind this? The justification is behind this is based on that we organize the items in terms of liquidity. So the most liquid item will come first, the least liquid item will come last in the asset. But in case of liability, our aim is that which liability I need to make clear on an earliest basis. So based on this, you will see the accounts payable is the first item we have listed in the current liabilities, and it needs to be cleared on a very earliest basis. Okay. So when we reformulate the balance sheet, we have to categorize these assets, these liabilities into operating assets and liabilities and finance assets and liabilities. So we have learned that how the template works for the operating assets and the operating liabilities. So we can categorize the assets into these operating assets and the financial assets, and we can categorize the liabilities into operating liabilities and the financial obligations. So we talked about these equations, and this will help us to understand the template of the reformulated balance sheet. Okay, so this often it is often easier to understand many of the items listed in the balance sheet, and we are much familiar, but sometimes we see the inclusion of other assets and other liabilities. In that case, we sometimes get confused to know because we do not have the idea that what are the assets involved in the other assets or what are the liabilities involved in the other liabilities. So in general, operating assets and operating liabilities are those assets and those liabilities which are directly involved with the business operation, and the assets and liabilities which we are categorizing as finance obligations and the financial assets are the financial obligations help us to raise cash for the operation or to finance our operation, and financial assets are precisely our investment, what we do after raising cash for operations from the financial obligations. We spend money for operating assets and operating liabilities, but when we have excess cash resources, we invest those resources to purchase some financial assets, and these financial assets are generates income for us, which obviously reflect in the income statement. You probably have learned the non-operating income. So non-operating income reflects the income which comes from particularly for the manufacturing companies. The non-operating income comes from the investment in financial assets. So before going to make a reformulated balance sheet or making reformulation, we need to learn some basic areas. First of all, we need to understand the business. We need to understand the business, and then it will help us to make the classification. So net financial obligations, someone has asked that she or he didn't get the net financial obligations. So we have some financial assets and we have some financial liabilities. You probably can recall that what financial liabilities we talked in the previous class, and we showed you some financial liabilities. What we are saying, the financial obligations, if it is like this from the when we have the liabilities and shareholders equity, we'll see that there are some operating liabilities, there are some financial liabilities. So what we need to do, we need to find out the financial liabilities, and from the financial liabilities we have to separate. So these are some examples of financial liabilities. Okay, so it can include the short-term borrowings, the long-term debt, the current maturities of long-term debt, short-term notes payable, obviously interest bearing, the lease obligation, preferred stock. So these are the financial liabilities. So when we take the financial liabilities total amount and subtract the total amount for the financial assets in which we have made investment. The difference between the financial liabilities and the financial assets is known as net financial obligations. Okay. Okay. So we have got it. Good. So what I was saying, that we need to have a clear idea about the business first before making the reformulation works. Okay. So now the question is, from where I will come to learn that what is the business and what about this business is and what kind of activities this business do. Okay. So let me take you to financial statement notes of Golden Harvest Agro Industries Limited. This is the company I referred to you in the previous class. Okay. So after their financial statements, you see the financial notes, and these are the notes to the financial statements, and these are the integral part of the financial statements. Okay. So they will explain in the first note what they do, what is the nature of business activity. Why it is essential? Unless we know it clearly, we do not know what will be their operating assets, what will be their operating liabilities, and what will not be their operating and what will not be their financial. Okay. So let me read it for you, that what kind of business activities are done by the Golden Harvest. Okay. So this company owns and operates the business of growing, procuring, purchasing, processing, packaging, warehousing, transporting, exporting, importing, distributing, and selling agriculture-based food products, vegetable processing. This is very clear statement, and they have mentioned the activities what they do. Okay. They do activities from growing agriculture-based food to the selling agriculture-based food. So you see, this is a total supply chain in which they are involved. They do not only purchase the agricultural-based food directly from the market. They themselves grow the agricultural-based food. Okay. They involved in growing the agriculture. As per the objectives of the memorandum of the company, could also establish any industrial processing unit based on agro-based raw material products within the country and export the same or meet local demand. And their memorandum of the company is permitting them to engage in any industrial processing which is obviously based on agro-based raw materials. Okay. So from this part, you will come to learn that what is about their business. So this is the first task you need to know. Okay. Otherwise, we will do several mistakes in identifying the operating assets and liabilities. Okay. So operating assets and operating liabilities generate net operating income for us, and the financial assets and financial liabilities, they generate financial income, I mean the financial assets. And when it is financial liabilities, it causes us to incur some financial expense. It causes incur some financial expenses. Say, for example, I was showing you that our short-term borrowings is a part of financial liabilities. So for this part, you have to incur some financial expenses. Okay. So what we do now, before going to the actual reformulation, we have to talk, or we have to spend about the items in the balance sheet to know that which one is operating and which one is financial. Okay. So the cash, the first item in the balance sheet, you see in the standard balance sheet, you see the cash and cash equivalent, the first item in the current asset. Okay. So we need cash for several purposes. So the purposes are grouped into two broad headings. So one is working cash and another one is excess cash. So if we have a clear idea that what is their business, say for example, Golden Harvest, that company needs cash for growing, for procuring, for supplying, for selling their goods. These are the cash required for their operation. Okay. So what they do, they often pay bills for their operation from their cash, and often what is done that cash is maintained in some accounts which are interest bearing, and that is most obvious. And when you see the cash in the balance sheet, often we understand, or often we like to understand, that this cash is the amount which has been kept by the accounts department in their drawer. So the thing is not like that. The cash they maintain, or they have their cash in their bank account. It can be in current account, non-interest bearing, or it can be in other interest bearing accounts. Now the question is, do they have their whole cash only for working purpose or only for operating purpose? I mean, for paying to the suppliers, or paying to the laborers in this purpose, for these purposes? The answer is no. So sometimes they have cash after paying the bills and after purchasing the assets. They have some cash excess, which is over the working cash. Okay, excess cash. So that excess cash, what they do, they invest in some, they invest some amount, but if they do not make investment, they can also keep this money in some interest-bearing accounts. It can be, obviously, when it is cash equivalent, this cash should not be kept in an account which is of 1 year maturity or 3 years maturity, or kind of 1 year FDR or 3 year FDR. Usually they maintain cash in some interest bearing accounts, which can be 3 months like this, or which can be for 90 days. Okay. So in that case, when they are not keeping cash for the working purpose, rather they are keeping cash for investing in short-term securities, or taking short-term deposit, interest-bearing deposits. In that case, they have some cash which are particularly can be categorized as financial assets. So we see the cash which is for the purpose of working. In that case, that portion of cash is operating asset, and the cash which is over the working cash, which has been kept in interest bearing accounts and which has been invested in some short-term securities, that will be considered as financial cash. So often what is given in the balance sheet, you might see some financial balance sheet using the GAAP standard in textbook, but if you see the financial statements from the recent annual reports, you see their annual reports have been prepared based on the IFRS standard. So we have these financial statements based on the IFRS. So let me take you to the balance sheet of the Golden Harvest Agro Industries Limited, how they are representing their cash, and what are the additional information they are disclosing about their cash. Okay. So you see that this is their consolidated statement of financial position, and we see they have included cash and cash equivalent. Okay. So this is the particular way of representing cash. Okay. Now, you have to look for the information in the notes number 15, whether it provides sufficient information to separate the cash into some operating cash or working cash and some cash into for financial assets or financial purposes. Okay, let me check it here. What are the details they have provided? They have provided a breakdown based on their companies. It is the parent company, Golden Harvest Agro Industries Limited, and Golden Harvest Dairy is a subsidiary of this company. And these are the breakdown based on the cash held by these two companies separately. Okay, next thing we see that they have broken down cash into three groups: cash in hand at head office, cash in hand at factory and depot office, cash at bank. So you see that which amount is the biggest amount out of their cash? The cash in hand at head office or factory and depot office or at bank? Which one is the biggest amount? Factory and depot, they have maintained some cash balances, and this is a very much bigger amount. And you see, compared to previous year, 2020, it has become approximately 3 times more. Okay, it has become approximately 3 times more. But cash in hand at office has reduced. Now the question is, which two items or three items or which item particularly look operating or working cash to you, and which cash seem as financial asset to you? First of all, respond with your answer for the operating cash. Cash in hand in bank is financing, others are operating. So this is the safe answer. So this is the safe answer for which reason? Cash in bank is financing and other cash are operating. The reason is that we do not have other information. Okay, but we see that we have been given information here. Fixed deposits with banks, maturity within 1 to 3 months. You see that I was saying about this. Maturity is within 1 to 3 months. That's why it is cash equivalent. Otherwise, it cannot be included in the cash equivalent. Okay. So details of cash at bank is given at annexure A. So let's look at the annexure A first. Then we'll talk about how can we classify. Let me find out the annexure A. This one is annexure B. Annexure C, but where is the annexure A? Interesting. They have mentioned that they have provided details in the A. Where is this part? Annex A. Let me take it to the finishing of notes. Yeah, here it is. Golden Harvest Agro Industries, their statement of cash at bank. These are the banks in which they are maintaining their accounts. These are the account numbers. So, and these are the amounts in this the latest period and in the latest date, and it is in the corresponding previous date. Okay, then this is their account number. Okay, so does it look like these are some mobile financial account? These accounts? I'm not confirmed, but it seems to me that these are kind of mobile financial account. Okay, good. So we see that they have provided all the details, and you see that from their name, then you can identify the categories of deposits. Okay, so when there is a CD, probably it indicates the current deposits or current account. So for the current account and the current deposits, by definition, it does not provide any financial benefits. But in our country, it is possible that current accounts also provide some financial benefits. Okay, so in that case, cash at bank is to be considered as financial assets because they are expecting some financial benefits. So if we do not have a clear understanding that how can we classify this cash into operating cash and break-even cash, financial cash, I mentioned in the previous class that there is a way that what analysts do. Analysts expect that 5%, if there were no breakdown of this, what I would do. In that case, I would take 5.5% of sales. It is based on an industry practice that how much the average company hold cash relative to their sales as a percentage. That percentage will be considered as working cash, and remaining will be considered as financial assets. Okay, so as the current account always enables the account holders to swipe their card and to make payment by keeping money in the account. So, and also provide some financial benefits. So it is safer to count the cash in bank always as financial assets. Okay. Now, before talking about the short-term notes receivable, let me give you an idea that why knowing the business is very critical to understand the reformulation. You see, there are some companies to some extent in some countries, but common in developed countries, which provide credit to the customers. And it is often difficult to think of that the cash what they maintain is financial or operating. Okay. So, for example, you probably have heard about the General Motors and what they do. They sell. They are familiar to us as automobile sellers and automobile producers. And what they do, they provide financing to their customers to purchase the automobiles at an installment. So you see, they provide financing, and they also earn interest. They also earn interest from their financing. So you see what they are doing. They are financing and they are providing cash, or they are providing credit to their customers. It might be considered as financial, but you see that these are part of their operation. They are doing this for the purpose of generating more sales of automobiles. In that case, what they do, they have. In that case, we have to understand that their assets might be financial. Some assets might be financial, but actually these are part of operating. So it might be kind of interest-bearing accounts receivable. Interest-bearing accounts receivable. So it might be considered as financial, but it is, in their case, it is considered as operating assets. Again, this is also common in some other companies which provide financing to their customers for the purpose of as a part of their operation. Okay. Then short-term notes receivable. Short-term notes receivable, and how can we break down this into trade receivable, or we have made the note. We have made the notes for the purpose of investment of cash. Okay. So the thing is that if the notes are temporary investment, I have made the notes for the purpose of temporary investment of my cash. In that case, it will be considered as financial assets. But if I have the note from my accounts receivable from my customers, in that case, it is to be considered as operating assets. Okay, so sometimes the financial purposes or financial assets category of the notes receivable, obviously it provides some interest income, and what I mentioned earlier in case of General Motors, what they do, they create these notes for the from the customer, and customers will be liable to pay. And what they do, they made investment. They made investment by giving credit their customers, and in that case, their trade receivables interest bearing is to be considered as operating asset. It is not their financial asset. Okay. Then we can talk about the debt investment. It is to be considered as financial assets. So how it works? Say, for example, Golden Harvest Company, they have purchased some bonds which are debt securities of a particular company. In that case, it is to be considered as financial assets. Okay. So it is usually it is an usual standard that the investment, what I am doing here, I mean the debt investment, needs to be reflected the market value on the balance sheet needs to be reflected on the market value, needs to be reflected the market value. Okay. And it is often required by the standards. But you see, in case of commercial banks, so they might, they often provide credit to their customers by purchasing the debt securities. So it is kind of debt investment for the bank. So debt investment for a commercial bank is not a part of their financial assets, rather it is part of their operation. Okay. So this is a kind of self-explanatory why commercial banks should be considering their debt investment as financial assets. Okay. Then we might have some short-term equity investment. We might have some long-term equity investment. So what does it mean? It means that you just have seen that Golden Harvest Agro Industries Company has investment, obviously equity investment in their Golden Harvest Dairy. So when they have their equity investment, that is part of their operating assets or financial assets. What do you think? If Golden Harvest has made equity investment in Golden Harvest Dairy, should it be considered as operating asset or financial assets? I see the differing responses. So I get response as operating assets and financial assets. So who are thinking the operating assets? Would you please explain why you are thinking the equity investment in subsidiary is to be considered as operating? Why you are considering it operating? And do you please explain? This equity investment will use for business operation purposes. Yeah, good. But the thing is that sometimes it can be used. It can be used for not from the equity perspective, but I am purchasing the equity shares of my subsidiary because I like to use my cash, use my excess cash, and I'm making it for the short term. I'm making this investment for short term. So in that case, it will be considered as what I'm doing. I'm considering it as a trading securities. In that case, it will be considered as financing or financing assets. Okay. So in subsidiary companies, when I'm enabling, I'm enabling them to make their operations. In that case, it will be considered as operating cash. Okay. So sometimes it is difficult to find out that their subsidiary business and exactly which securities of the subsidiary has been purchased and what is the nature of that investment. So in that case, we need to use some judgment. Okay. Someone has asked if they invested in their business that could be operating, but investment in subsidiary means investing in other business or operation. Yeah, when it is subsidiary, in that case we consider it as operating. Okay, we consider it as a operating asset when it is subsidiary. But if it is for the purpose of a kind of trading, in that case we will consider it if they are part of that. We need to look at what is their purposes of using their cash. Okay. But if they do it for their subsidiary or enabling operation of their subsidiary, we consider it as an operating assets. And next is short-term notes payable. Where what we do, we need to check that for what purposes we have issued we have this short notes liability. So sometimes it can come from the accounts payable because we have created these trade notes. We have issued accounts payable has created these trade notes and we have signed on it. And this is as accounts payable or suppliers are part of our operation. In that case, it is good to consider as operating. But if we take cash by short-term notes, in that case, it will be considered as financial. Okay, so we need to check that when we take the short-term notes for the purpose of borrowing, we also incur interest expenses. And lease assets, we talked about lease assets in the understanding of balance sheet in previous classes, that we need to understand it very clearly whether it is operating assets, operating lease or financial lease based on some criteria. And lease assets are reported in the balance sheet. Lease assets are reported in the balance sheet as an operating assets by thinking of the present value of all the lease payments. So if it is a part of capital lease, I'm capitalizing the lease. I'm considering it that, say, for example, the lease period is 3.8 years and the economic life of the leased asset is 4 years. So there are some other criteria, but based on this, I have considered that this is a capital lease. But if it is an operating lease, in that case, this will not appear in the balance sheet. This will appear in the off-balance sheet. Okay, and the lease liabilities is always the financial obligations and deferred tax assets and deferred tax liabilities. It arises because of the differences in the book value in the balance sheet, in the financial statement, and carrying value in the tax statement or tax financial statements. So these differences are temporary, and these differences arises because of the accounting difference in calculating this value, the carrying value and the book value, and these are considered as operating. If it is deferred tax assets, it is considered as operating assets, and if it is deferred tax liabilities, it is considered as operating liabilities. And deferred revenue and accrued expenses, these are so clear to understand that we need to consider it as operating revenue, the operating assets, and accrued expenses. Deferred revenue is a part of our operating liabilities, and accrued expenses is a part of our operating liabilities. And minority interest, what is it? We sometimes have equity investment in some companies, and the investment amount is not 51%, and the investment amount is a percentage which is less than 51%. I mean, within 49%. So in that case, what we can do, can we consider it as a part of equity? The answer is no, we cannot consider it as a part of equity. Rather, we have to count it separately. You probably can recall that we wrote the net operating assets and we subtracted net financial obligations. We got the common shareholders equity. So instead of including the minority interest in the operating or financial category, we have to include the minority interest separately with the common shareholders equity. Okay. So this is not part of financial, or this is not part of operating. So sometimes we are inclined to think that it is a part of financial obligations. Okay. Now it is critical that for financial firms like bank, insurance company, the financial institutions, most of their financial items, which are generally financial items, they need to be considered as operating assets and operating liabilities. Okay. So let's try to apply some understanding what we have learned. Say cash and cash equivalent. I mean, for the Nike company, we have been presented the balance sheet, which is prepared based on the GAAP standard, and we do not know the details, but we can identify some components. We can identify the components as operating and financial based on our general understanding. We have some notes here, but that notes have not been mentioned. That notes have not been mentioned in the text or in the slide. So let's try to make some application of general understanding. So when it is cash and cash equivalent, so if you have no more information, the company is Nike. What do you think? Should we? It would be safe to count all the cash as operating or financing? We have cash for 2004 and 2003. Yeah, good. As this is not a financial company, this is a manufacturing company. So what can we do as a typical approach? We can take a 0.5% of sales as operating and 5% of sales as operating, and the remaining amount as financial. Let's check whether we have the income statement. I do not know whether we have the income statement here. It should be here. Okay. So I do not know from where the income statement has been given, but what we are applying here, that if we have the sales amount, we will take 0.5% of sales as a operating cash, and the remaining cash, after subtracting this operating cash from this amount, cash and cash equivalent, we will take the remaining amount to financial assets. Okay, so these are the amount which has been estimated based on the 0.5% of sales, and the remaining has been taken into financial obligations. Okay, here it has been presented in this way. Okay, sorry, no, this is one of the balance sheet. Yeah, this is the reformulated. Okay, next thing, short-term investment. So we see the short-term investment. What we can do for the short-term investment? Can it be considered as operating, or it can be considered as financial? It can be considered as financial, short-term investment. Okay. Okay. So we're taking all short-term investment. It was absent in the 2003 in the financial. Okay, here it is. Then accounts receivable less allowance for doubtful accounts of this amount in 2 years respectively. So we have to see that out of the account receivable, you probably can recall the trade receivables. So it has been created solely based on the solely based for operating purposes. So in that case, this amount will be directly transferred to the operating assets. So here it is, the accounts receivable. Accounts receivable total amount has been taken in the operating here. So for what reason? Because we do not have an idea that this receivable, the related item, what I mentioned in the discussion, is notes receivable. Notes receivable. If I provide credit to my customers, which is interest bearing, and if you are a company like General Motors, which provide financing to your credit to your customer, in that case, it should be considered as part of operating assets. Inventory, it is generally clear that it is to be operating. Okay, here it is the inventory, the total amount 1634 and 1515. Okay, Next thing, deferred income tax, as it is part of the current asset, it is the deferred current assets. Deferred income, deferred tax assets. Okay. So as I mentioned, it is to be included in the operating part or operating asset part, right? So what has been done here, deferred income tax, probably it has been made net. I need to check it. Deferred income tax operating liabilities is here 418. And is there any deferred tax? Yeah, deferred income tax and other assets 456. So we need to check that how it has been estimated together. Probably there has been a sum up by adding these amounts. We need to check the deferred, okay, prepaid expenses and other current assets. So generally it is to be considered as operating assets as long as we have no other information. So prepaid expenses as 370. Prepaid expenses 332. These are here. There's some general rounding. Okay, property, plant and equipment. It is a part of our operating asset out of our long-term assets. Property, plant and equipment total amount 1587. Identifiable intangible assets. These are part of our operating assets. We need to check that whether they have made any, okay, goodwill. Identifiable intangible assets, there has, we need to check whether, okay, 366.3. Here it is. Okay, it has been made here, 366. Total amount and the deferred income taxes and other assets. So this is the long-term portion and this is the short-term portion. And now, if we add this 6, 5, 4, yeah. So you have got this amount, deferred income taxes. Total amount needs to be considered as operating. The long-term portion plus short-term portion. So both needs to be summed up and needs to be transferred operating asset in this part 456. Okay. So within a very short time, let's try to check that which items will be considered out of the liabilities and in the financial and operating part. So current portion of the long-term debt, you see that this is part of the financing. This is part of the financing. That's why it needs to be considered as financial obligation. This one, current portion of long-term debt. Okay. And notes payable, we do not know how much of this notes is operating or how much of this note is financial. So we have to find out some ways. Okay. So it has been mentioned that notes payable are interest bearing. So that what can we do? We can take it to the financial obligations instead of taking it operating liabilities. So here it is notes payable, assuming that it is interest bearing. If we have been mentioned that notes payable is not interest bearing, we would consider it as a part of the payables generated for the purpose of trade. And the accounts payable, often we see some confusions here. Accounts payable, how can we allocate it for trading and for the purpose of financing? And we see that it has been mentioned that accounts payable are interest bearing, and these are classified as financing obligations. So total accounts payable some accounts payable are interest bearing. So there is a classification probably, and we need to check this note. It is not available in the slide or text. We need to check it. Out of this, some portion which is interest bearing has been transferred to financial, and which is not interest bearing, that has been transferred to operating. And about the accrued liabilities, and out of the accrued liabilities, excluding the dividend amount, dividend payable is the amount which needs to be included in the equity, and it is not a part of financial liabilities, but it needs to be added to the common shareholders' equity. And the remaining amount out of this one, I mean, accrued liabilities, that amount needs to be considered as operating liabilities. The amount dividend payable has been transferred separately to common shareholders' equity. The income tax payable, again, it is part of operating liabilities. The deferred income tax, probably it is sum up of two things. One is this part from short term, and the one is here from the deferred income taxes and other liabilities. We need to separate the other liabilities from here. And out of the long-term liabilities, the long-term debt is clearly finance obligations. And we have talked about deferred income taxes. It is to be part of operating. And commitments and contingencies, we need to look at in more detail what are kind of commitments here. A redeemable preferred stock, it is clearly a finance obligations. Okay. And you see the redeemable preferred stock. Okay. It is part of net financial obligations. And out of the remaining part here, these are part of common shareholders' equity. These are part of common shareholders' equity. Okay, so these are part of common shareholders' equity. So what is the task here? The task is that we need to explore it in more detail, like the way that we have explored the cash and cash equivalent for the Golden Harvest Agro Industries Company. Okay, so we'll talk more about the reformulation in the next class, and for now we can stop here.